Stock markets are coming under pressure and the dollar is on the rise. Hello traders, this is Fawad Razak, market analyst for City Index. Today is the 29th of May 2024. So as you can see on the right hand side, equity indices are down across the board. And this is in part because of concerns about the potential for US interest rates to remain elevated for longer. We also had a stronger than expected CPI report from Australia, which has pushed out rate cut expectations there further out into the new year. In the US, we've heard from several Fed officials all suggesting that interest rates will remain high for longer because of the sticky nature of inflation. Speaking of which, we'll have the core PCE price index later this week, which could have major implications on the markets. And now ahead of that, we've seen the indices come back down a little bit. Last week, there was an interesting pattern on the S&P 500, this bearish engulfing candle that was formed when the index broke to a new record high, but failed to hold there. And as a result, the market closed at its lows on Thursday. But the following day, on Friday, the markets rebounded ahead of the long weekend. That momentum didn't really carry through this week. The selling pressure has resumed, and we're now retesting the areas that were last tested on Thursday of last week. So let's see if this selling pressure has any legs, or will the dip be bought once again, especially in the technology sector, where stocks are continuing to push higher despite all the macro concerns. Indeed, if you look at the Nasdaq 100, it's only down a little bit from its old record highs. Whereas if you see the likes of the Dow, for example, the Dow is down for several straight days, around 4% from its record high. So the markets are performing quite mixed in the US, with technology continuing to outperform. The S&P 500, going back to this chart now, this area here, right between 5,250 to April's high of 5,277. This is a key zone that needs to be defended by the bulls if they want to maintain control of price action. Failure to do so, we could see the start of a potential correction, which could see the index fall all the way down to this level right here at 5,122, which was the high from 29th of April before the breakout that caused the index to rally to new record highs. That level is now going to be very important on any potential pullback. And below that, we have the 5,000 level, which is a psychologically important level to watch out for as well. So there's lots of support levels that could provide support for the market. But the key question right now is, will we see any downside follow through this time? Every time we've seen a bit of bearish price action, there's been a lack of any significant downside follow through. But will things change this time? Time will tell. In the FX space, the dollar index is bouncing back from this bullish trend line and the 200-day moving average, which was tested yesterday and held. We formed a little doji candle here, and now we're seeing some follow through on the upside. At the moment, the dollar index is above 105, supported by the dollar yen, but all the other major currencies are weaker against the US dollar. For example, the Aussie dollar. Now, we mentioned the fact that we had a stronger than expected CPI data from Australia overnight, which pushed rate cut expectations further out over there. But this offered only mild support for the Aussie. And this is in part because of the risk-off tone we've seen across the financial markets, with equity markets down. So the dollar is being supported by hawkish Fed, risk-off tone in the markets, and rising bond yields. All of those factors combined are helping to support the US dollar against all the major currencies. The Aussie dollar needs to climb back above the 66.50 level and the high from March at around 66.67 before its bullish trend can resume. For now, it looks like it's consolidating ahead of the core PCE price index data on Friday. The more interesting currency pair to watch, in my view, is the dollar yen, which is continuing to grind higher, not only because of a strong dollar, but because of the Bank of Japan's ongoing loose monetary policy stance, and rising bond yields as well is helping to weigh on low-yielding Japanese yen. Now, the dollar yen looks like it's about to take out 158 which was the high prior to the Bank of Japan's second intervention or suspected intervention that took place on the 1st of May, which caused around 500 pip drop in a matter of minutes. It looks like that level is going to be taken out. Now, the Bank of Japan or the Ministry of Finance in Japan, they have said that they are more concerned about the speed at which the Japanese yen is weakening is when they tend to intervene. So this slow grind is unlikely to trigger another intervention. But if we see the pace of the yen selling accelerate, so if you see a sharp move from around current levels towards, let's say, 160 in the next couple of days, I think that could be a trigger for another potential intervention from the Bank of Japan. So do watch out for that. But for the time being, it looks like the Japanese yen or the dollar yen is heading towards 160 level, which was tested in April. And ahead of that, we have 158 as the next possible resistance level, but it looks more likely that 160 could be where things might get more interesting for this pair. In terms of support, 156.55, the high of this candle that was formed in the middle of the month, was resistance. It turned into support once we went above it. So that level is now going to be key support. For as long as we remain above that level, the short-term path of least resistance is going to be to the upside. Below that, we have 155, where we also have the bullish trend line converging as well. Now, for more market insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.